If you ever wondered what index universal life insurance is, the history behind it and how it came to be, and how is it regulated, that's exactly what I'm going to be covering in this video. My goal is to give you a basic understanding of what index universal life insurance is, the history behind it, and the internal revenue codes and tax citations that regulate it. Index universal life insurance, or better known as an IUL, was introduced in 1997 as interest rates dropped from the highs of the 80s. It was designed to offer stronger growth opportunities than universal life without the volatility of variable universal life. Now, how it does this is the cash value is linked to a stock market index like the S&P 500, but is not directly invested into the market. So how that works is it uses a floor of 0 to 1%, which is carrier specific, to prevent the losses, and a cap and a participation rate to capture a portion of the gains. So for example, if the index does 15%, but yet you're capped at 10%, well, your rate of return is going to be 10%. Now, how that reflects back into the participation rate is of the cap, there's a participation rate of 100%, which means you get 100% of the 10% rate of return. I don't want to dive too deep into that. I just want to keep it basic for the purpose of this video, but I will discuss that in a future video. Now, IULs are a hybrid financial tool that safeguards your wealth, provides lifelong tax-free income, offers liquidity when you need it, and preserves your legacy all in one structure. In the early 1980s, E.F. Hutton, a leading brokerage firm at the time, popularized the strategy of funding universal life policies with a lump sum premium while minimizing the death benefit. Now, affluent individuals took advantage of this strategy. The goal was not just protection, but tax-deferred growth and tax-free access to funds. The IRS challenged this strategy by taking E.F. Hutton to court. They were accusing E.F. Hutton of using these as tax shelters and avoiding paying taxes. So the IRS saw a loss of tax revenue. So they took E.F. Hutton to court, but E.F. Hutton won because E.F. Hutton was in compliance with Internal Revenue Code 72E. Now, this widespread use of universal life as a tax shelter triggered Congress to enact TEFRA, which is the Tax Equity and Fiscal Responsibility Act of 1982, DEFRA, which is the Deficit Reduction Act of 1984, and TAMRA, which is the Technical and Miscellaneous Revenue Act of 1988. IRC stands for Internal Revenue Code. So IRC 101A defines income tax exclusions for life insurance death benefits. It was enacted in the Revenue Act of 1913. It ensures that life insurance death benefits are excluded from gross income and then for income tax-free to beneficiaries. This provision underpins why life insurance is attractive for wealth transfer and estate planning. IRC 72E defines the taxation of life insurance distributions. It was enacted in the Revenue Act of 1954 with significant amendments in the 1980s. It governs the taxation treatment of the policy withdrawals, loans, and surrender value. MEC, a modified endowment contract, or MEC policy. The tax treatment is LIFO, which is last in, first out, meaning distributions are with gains first, taxable as ordinary income, and they're subject to a 10% penalty if taken before 59 and a half. This is also the same as with your traditional qualified accounts, i.e. 401ks or traditional IRA. Now, a non-MEC policy, the tax treatment is FIFO, first in, first out, meaning withdrawals first come from the basis, which are premiums paid, making them tax-free. Which brings us to the next, which is IRC 7702, which is a federal definition of life insurance. Enacted in conjunction with the enactment of the Deficit Reduction Act of 1984, DEFRA. This establishes the tests a policy must pass to qualify as life insurance for tax purposes. And those two tests are called the guideline premium test or guideline premium corridor test, the cash value accumulation test. Now, both of these tests are based on your age, your gender, and your health, because this sets the ratio of your premiums paid into what the death benefit is going to be. Okay. Now, this sets the framework for max funding by establishing how much premium can be contributed relative to the policy's death benefit. This prevents policies from becoming a MEC and treated as taxable investments. The Tax Equity and Fiscal Responsibility Act of 1982, better known as TEFRA, was signed by President Reagan in September 3rd of 1982. TEFRA was the government's first attempt to curtail the abuse of life insurance as a tax shelter, regulated life insurance by imposing funding guidelines and defining how much premium could be paid relative to death benefit. The Deficit Reduction Act of 1984, better known as DEFRA, signed by President Reagan on July 18th of 1984. This redefined TEFRA framework by officially codifying Internal Revenue Code 7702. It introduced the guideline premium test and cash value accumulation test. This law cemented the tests still used today to determine if the policy qualifies as life insurance for favorable tax treatment. It shaped the allowable structure for max funding. The Technical and Miscellaneous Revenue Act of 1988, better known as TAMRA, was signed by President Reagan November 10th of 1988. It introduced the 7-pay test, which limits how much premium can be paid into a policy during the first 7 years. If violated, the policy becomes a modified endowment contract and restricts the ability to take tax-free loans and withdrawals. Just want to elaborate on this just a little bit. And I want to kind of focus on this 7-pay test. In the insurance industry, the 7-pay is also known as the non-MEC premium, or what we just learned today, TAMRA. So just keep that in mind when talking with an agent and you're setting one of these policies up, understanding what the 7-pay is. Now, 7-pay was really designed for whole life because whole life is pretty rigid in how it's structured and everything. That's why universal life came out, because it's more flexible with premiums and death benefits, unlike whole life. So whole life had it to where you couldn't fund it any faster than 7 years. But the beauty of index universal life is you can fund it as fast as 3 years, and you can fund it longer than that. There's no set, but you can fund it as fast as 3 years. Now, what that is based on your age. The younger you are, the faster you can max fund these policies. So today we covered on what index universal life insurance is. We talked about the history of how it came to be. And we also talked about how is it regulated and governed. Now, if this resonates with you and you would like to see a personal tailored illustration with your figures inside, go ahead and book a call. And I would love to design one of these and walk you through it and explain it in detail so you fully see how it truly works and the mechanics of it. Now, if you currently already have an IUL and you're wondering if your IUL is actually optimized to its full potential, you can go ahead and book a call as well. I would love to look over it and see where we can make any adjustments to your current policy you have. I do thank you for your time and thank you for watching this video to the end, and I'll see you in the next one.